Palantir Technologies, PLTR, Stock Analysis, Navigating the AI Frontier. Disclaimer: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Introduction: Palantir Technologies Incorporated, NYSE, PLTR, has emerged as a prominent player in the realm of big data analytics, offering sophisticated software solutions to both government and commercial sectors. As of May 17, 2025, Palantir's stock is trading at $130.18, reflecting a significant surge in investor confidence. This analysis delves into Palantir's financial performance, strategic initiatives, competitive positioning, and future prospects. Financial performance: robust growth trajectory. Q1 FY 2025 highlights revenue, $726 million, marking a 30% year-over-year increase. Adjusted EPS, 10 cents, reflecting a 43% growth compared to the previous year. Free cash flow, $4.56 billion, underscoring the company's operational efficiency. Full year 2024 performance: revenue, $2.87 billion, a 29% increase from 2023. Net income, positive, indicating a return to profitability. Adjusted operating margin, 38%, demonstrating strong operational leverage. These figures underscore Palantir's ability to scale its operations while maintaining profitability, positioning it favorably in the competitive landscape. Strategic initiatives: capitalizing on AI and data analytics. AI integration. Palantir has integrated large language models, LLMs, into its platforms, Gotham and Foundry, through its AI platform, Palantir 8. This integration enables clients to leverage advanced AI capabilities for data analysis and decision-making. Notable developments include partnerships, collaborations with Databricks and Microsoft Azure Government to enhance data processing and cloud capabilities. Client adoption: a significant increase in the adoption of AI-driven solutions across various sectors, including defense, healthcare, and finance. Defense sector expansion. Titan program. Palantir's involvement in the U.S. Army's Titan program exemplifies its expanding footprint in the defense sector. Under a $178 million contract, Palantir is integrating its AI platform into truck-mounted units that consolidate sensor data from land, air, and space to provide real-time targeting intelligence. This initiative positions Palantir as a key player in modern defense technologies. Competitive landscape. Positioning in the AI ecosystem. Palantir operates in a competitive environment characterized by government contracts. While Palantir's reliance on government contracts provides stability, it also exposes the company to geopolitical risks and policy changes. Commercial sector growth. The company's expansion into commercial sectors is promising, with revenue from U.S. commercial contracts increasing by 134% in 2024. Valuation concerns. Despite strong financial performance, Palantir's stock is trading at a forward P/E ratio of approximately 275, raising concerns about its valuation relative to industry peers. Future outlook. Growth drivers and risks. Growth catalysts. AI demand. The increasing adoption of AI across industries presents significant growth opportunities for Palantir's AI-driven solutions. Defense spending. Rising U.S. defense budgets and global geopolitical tensions boost demand for Palantir's defense-related offerings. Commercial expansion. Strategic partnerships and expanding use cases in sectors like healthcare and finance contribute to Palantir's growth prospects. Risk factors. Customer concentration. Approximately 20 major clients account for 65 to 70% of revenue, making Palantir vulnerable to the loss of key contracts. Regulatory challenges. Data privacy concerns and regulatory scrutiny, especially in Europe, could impact Palantir's operations. Valuation volatility. The company's high valuation metrics may lead to increased stock price volatility, particularly if growth expectations are not met. Conclusion: Palantir Technologies Incorporated has demonstrated robust financial performance and strategic initiatives that position it well in the AI and data analytics sectors. However, investors should consider the company's high valuation and associated risks when evaluating its investment potential. As always, conducting thorough research and consulting with financial advisors is recommended before making investment decisions. Note: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. NVIDIA Corporation, NVDA, Stock Analysis, Dominating the AI Revolution. Disclaimer: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Introduction: NVIDIA Corporation, Nasdaq, NVDA, has evolved from a leading graphics processing unit (GPU) manufacturer for gaming into a pivotal player in the artificial intelligence (AI) revolution. As of May 17, 2025, NVIDIA's stock is trading at $135.40, reflecting investor confidence in its strategic direction and market positioning. In this analysis, we delve into NVIDIA's recent financial performance, strategic initiatives, competitive landscape, and future prospects, providing a comprehensive view of the company's standing in the rapidly advancing AI industry. Financial performance: unprecedented growth. First quarter fiscal year 2025 overview. NVIDIA reported exceptional financial results for the first quarter of fiscal year 2025. Revenue: $26.04 billion, a 262% increase year-over-year. Earnings per share, EPS, 60 cents, up 623% from the previous year. Gross margin, 78.4%, reflecting strong operational efficiency. Net income, $14.88 billion, with a net margin of 57.1%. Free cash flow, $14.98 billion, highlighting robust cash generation capabilities. These results underscore NVIDIA's dominant position in the AI hardware market and its ability to capitalize on the growing demand for AI infrastructure. Second quarter fiscal year 2025 outlook. For the second quarter of fiscal year 2025, NVIDIA provided the following guidance: revenue, expected to be $28.0 billion, plus or minus 2%. Gross margin, GAAP and non-GAAP gross margins expected to be 74.8% and 75.5%, respectively. Operating expenses, GAAP and non-GAAP operating expenses expected to be approximately $4.0 billion and $2.8 billion, respectively. Strategic initiatives, leading the AI infrastructure market. Blackwell GPU architecture. NVIDIA's latest GPU architecture, Blackwell, is designed to support AI model development at a trillion-parameter scale. The Blackwell-powered DGX SuperPod aims to revolutionize generative AI supercomputing, offering significant performance improvements and energy efficiency. Expansion into sovereign AI markets. NVIDIA is expanding its reach into sovereign AI markets, with notable initiatives including Saudi Arabia, approval for the transfer of advanced AI chips to support the country's AI investment initiative; Oman, under Crown Prince Mohammed bin Salman's $100 billion Project Transcendence; China, establishment of a new research and development center in Shanghai to maintain a presence in the Chinese market amid ongoing U.S. export controls. These strategic moves position NVIDIA to capitalize on global AI infrastructure investments. Acquisitions to enhance AI capabilities. NVIDIA's acquisition of AI infrastructure business run for $700 million and investment in European GPU cluster specialist Nebius strengthen its position in the AI market. These acquisitions enable NVIDIA to expand its offerings and better serve customers in the growing AI infrastructure sector. Competitive landscape. Maintaining market leadership, NVIDIA faces competition from companies like AMD and Intel in the AI hardware market. However, NVIDIA maintains a dominant market share due to advanced GPU architectures, successive architectures, Ampere, Hopper, and Blackwell, offering increased performance to support AI model development. CUDA software platform, a key component enabling developers to effectively program GPUs, enhancing the overall value proposition of NVIDIA's hardware. Ecosystem integration, strong partnerships with major cloud providers and enterprises, ensuring widespread adoption of NVIDIA's AI solutions. Future outlook, capitalizing on AI growth, AI infrastructure spending. Investment banking and financial services provider Jefferies estimates that NVIDIA could ship approximately 6 million data center GPUs in 2025, generating $180 billion to $200 billion in revenue. Morgan Stanley projects that NVIDIA could generate $210 billion in revenue from sales of its Blackwell systems alone in 2025, indicating significant growth potential. Government demand for AI hardware. Governments are increasingly investing in high-performance GPUs to develop their own large language models, LLMs, driving demand for NVIDIA's AI hardware. This trend is expected to continue as nations seek to enhance their AI capabilities. Conclusion: NVIDIA Corporation stands at the forefront of the AI revolution, with exceptional financial performance, strategic initiatives to expand its AI infrastructure offerings, and a dominant position in the competitive landscape. While challenges such as geopolitical tensions and regulatory considerations persist, NVIDIA's proactive approach and innovative solutions position it well for sustained growth in the evolving AI industry. Investors seeking exposure to a company leading the charge in AI infrastructure may find NVIDIA Corporation a compelling addition to their portfolios. Note: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Marvell Technology Incorporated, MRVL, Stock Analysis, Navigating the AI Infrastructure Boom. Disclaimer: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Introduction: Marvell Technology Incorporated, NASDAQ, MRVL, has emerged as a significant player in the semiconductor industry, particularly in the realm of artificial intelligence, AI, infrastructure. As of May 17, 2025, Marvell stock is trading at $63.76, reflecting investor confidence in its strategic direction and market positioning. In this analysis, we delve into Marvell's recent financial performance, strategic initiatives, competitive landscape, and future prospects, providing a comprehensive view of the company's standing in the rapidly advancing AI infrastructure sector. Financial performance: robust growth amidst market challenges. First quarter fiscal year 2025 overview. Marvell reported the following financial results for the first quarter of fiscal year 2025. Revenue: $1.161 billion, exceeding the midpoint of guidance, but declining 12% year-over-year and 19% sequentially. Data center revenue: $812 million, accounting for 70% of total revenue. Non-GAAP gross margin: 62.4%. Non-GAAP operating margin: 23.3%. Non-GAAP earnings per share: 24 cents, slightly above the midpoint of guidance. Despite a year-over-year decline in overall revenue, the data center segment demonstrated significant growth, underscoring Marvell's strong position in the AI infrastructure market. Fourth quarter fiscal year 2025 highlights. For the fourth quarter of fiscal year 2025, Marvell reported revenue: $1.817 billion, a 27% year-over-year increase and 20% sequential growth. Data center revenue, $1.37 billion, representing a 78% year-over-year increase and 24% sequential growth. Non-GAAP earnings per share, 60 cents, a 40% sequential increase. Non-GAAP gross margin, 60.1%. Non-GAAP operating margin, 33.7%. These results highlight Marvell's strong performance in its core data center business, driven by increasing demand for AI infrastructure. Strategic initiatives, capitalizing on AI infrastructure demand. Custom AI silicon and electro-optics solutions. Marvell has positioned itself at the forefront of the AI infrastructure boom through its development of custom AI silicon and electro-optics solutions. The company's 1.6T PAM DSP, built on a 5 nanometers process, and its subsequent 3 nanometers version with 20% lower power consumption, have garnered significant attention in the industry. These innovations cater to the growing need for high bandwidth, energy-efficient solutions in AI data centers. Partnerships with hyperscalers. Marvell has established strategic partnerships with major hyperscalers, including Amazon. In December 2024, Marvell and Amazon entered into a 5-year agreement under which Marvell will supply custom AI processors and networking chips for Amazon's data centers. This collaboration underscores the increasing reliance on Marvell solutions for AI workloads. Expansion into next-generation networking. Marvell is expanding its reach in next-generation networking through its development of co-packaged optics technology and its industry's first 2 nanometers silicon IP for cloud and AI workloads. These advancements position Marvell to capitalize on the shift from copper to optical connectivity in AI infrastructure, representing a significant growth opportunity. Competitive landscape. Positioning in the semiconductor industry. Marvell operates in a competitive environment characterized by custom AI silicon, competing with companies like NVIDIA and Intel in the development of custom AI processors. Networking solutions. Rivals include Broadcom and Cisco in the provision of networking chips and solutions. Electro-optics, competing with companies like Intel and Inphi in the development of electro-optics solutions. Marvell's strategic focus on custom AI silicon and electro-optics differentiates it from competitors, positioning it well to capitalize on the growing demand for AI infrastructure. Market outlook, growth drivers and risks. Growth catalysts. AI infrastructure demand. Increasing adoption of AI technologies drives demand for robust data infrastructure. Strategic partnerships, collaborations with hyperscalers provide a steady revenue stream and validate Marvell's solutions. Technological advancements, innovations in custom AI silicon and electro-optics solutions enhance Marvell's competitive edge. Risk factors. Market volatility, fluctuations in the semiconductor market can impact financial performance. Competitive pressures, intense competition in the AI infrastructure space may affect market share. Regulatory challenges, changes in regulations can impact operations and profitability. Conclusion, a strategic position for sustainable growth. Marvell Technology Incorporated has demonstrated robust financial performance and strategic initiatives that position it well in the rapidly advancing AI infrastructure sector. While challenges such as market volatility and competitive pressures persist, Marvell's focus on custom AI silicon and electro-optics solutions, coupled with strategic partnerships, provides a solid foundation for sustained growth. Investors seeking exposure to a company at the forefront of AI infrastructure may find Marvell Technology Incorporated a compelling addition to their portfolios. Note: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Netflix Incorporated, NFLX, Stock Analysis, Streaming Giants Resilience and Growth. Disclaimer: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Introduction: Netflix Incorporated, NASDAQ, NFLX, has solidified its position as a leader in the streaming industry, demonstrating resilience and adaptability in a competitive market. As of May 17, 2025, Netflix's stock is trading at $1,191.53, reflecting investor confidence in its strategic direction and market positioning. Financial performance: robust growth amidst market challenges. First quarter fiscal year 2025 overview. Netflix reported the following financial results for the first quarter of fiscal year 2025. Revenue: $10.54 billion, a 12.5% increase year-over-year. Earnings per share, EPS, $6.61, surpassing the consensus estimate of $5.69. Operating margin, 31.7%, up from 28.1% in the same quarter last year. Free cash flow margin, 25.2%, up from 13.5% in the previous quarter. Market capitalization, $411.30 billion. Capifin +3 Financial Content +3 NASDAQ +3 Financial Content +3 NASDAQ +3 NASDAQ +3. These results underscore Netflix's strong financial health and operational efficiency. Guidance for fiscal year 2025. Looking ahead, Netflix has provided the following guidance for fiscal year 2025: NASDAQ revenue, between $43.5 billion and $44.5 billion. Operating margin, 29%. Free cash flow, approximately $8 billion. Panabi. The company also announced a $15 billion share repurchase program, signaling confidence in its future cash generation and commitment to shareholder returns. Panabi strategic initiatives: capitalizing on market trends. Expansion of ad-supported tier. Netflix's ad-supported subscription tier has seen significant growth, now reporting 94 million monthly active users globally, a 34% increase since November 2024. The company has launched its proprietary ad tech platform in the US and Canada, with plans to expand to 10 additional markets. This move positions Netflix to capitalize on the growing demand for advertising in the streaming industry. Investors Business Daily. Capifin +1 NASDAQ +1 integration of AI-generated advertising. In a bid to enhance advertising effectiveness, Netflix plans to introduce AI-generated advertisements within its ad-supported subscription tier by 2026. These innovative ads will feature seamless integration of advertiser products into the platform's original shows and movies, creating a more immersive advertising experience. The Times of India live sports programming. Netflix is expanding its content offerings to include live sports programming. The company has secured broadcasting rights for events such as WWE Raw and an upcoming NFL Christmas Day game in 2025. This strategic move aims to attract a broader audience and increase subscriber engagement. Panabi +2 Baron '(S +2 Capifin +2 Capifin. Competitive landscape: navigating industry challenges. Despite facing challenges such as trade tensions and economic uncertainty, Netflix has demonstrated resilience. The company's digital content model allows it to avoid cost hikes from tariffs, unlike competitors reliant on physical goods. Analysts maintain a positive outlook on Netflix, citing its strong content library, expanding advertising business, and strategic investments in original programming. Baron '(S +1 Baron '(S +1 Monexa AI Future Outlook, Growth Drivers and Risks. Growth catalysts. Ad-supported subscription tier. Continued growth in the ad-supported tier is expected to contribute significantly to revenue. Live sports programming. Expansion into live sports programming is anticipated to attract new subscribers and increase engagement. AI-generated advertising. The introduction of AI-generated advertisements is expected to enhance advertising effectiveness and user experience. Barron's The Times of India risk factors market competition. Intense competition from other streaming platforms may impact subscriber growth. Content costs. High content spending required to sustain engagement could affect profitability. Regulatory challenges. Changes in regulations could impact operations and profitability. Capifin conclusion. Netflix Incorporated has demonstrated robust financial performance and strategic initiatives that position it well in the competitive streaming industry. While challenges persist, the company's focus on expanding its ad-supported subscription tier, integrating AI-generated advertising, and offering live sports programming provides a solid foundation for sustained growth. Capifin +2 Gold Eagle Cooperative +2 Nasdaq +2 Note: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Abbott Laboratories, ABT, Stock Analysis, Navigating Growth in a Dynamic Healthcare Landscape. Current stock price, $134.80, as of May 17, 2025. Market Watch market cap, approximately $235 billion. P ratio, approximately 26. Dividend yield, 1.6%. Company overview. Abbott Laboratories is a global healthcare company with a diverse portfolio spanning diagnostics, medical devices, nutrition, and branded generic pharmaceuticals. Headquartered in Abbott Park, Illinois, the company operates in over 160 countries and is known for its commitment to innovation and improving patient outcomes. Financial performance. In first quarter of 2025, Abbott reported robust financial results, demonstrating resilience and growth across its business segments. Revenue, $10.36 billion, a 4% increase year-over-year, slightly missing the consensus estimate of $10.41 billion. MarketWatch +1 Smart Karma +1 net earnings, $1.33 billion, or 76 cents per share, GAAP, an 8.6% increase from the previous year. MarketWatch +1 Alpha Street +1 adjusted EPS, $1.09, surpassing the forecast of $1.07 and marking the company's 21st consecutive quarterly EPS beat. Smart Karma +3 MarketWatch +3 Investing.com +3 gross margin, expanded by 140 basis points to 57.1%, indicating improved profitability. Investing.com +1 Nasdaq +1 operating margin, increased by 130 basis points to 21%. Investing.com. These results underscore Abbott's strong financial health and its ability to navigate a dynamic healthcare environment. Business segment performance. Abbott's diversified business model contributed to its strong performance in Q1 2025. Abbott Medical Devices, sales increased by 9.9% to $4.90 billion, driven by a 16.5% surge in diabetes product sales, particularly a notable 18.3% increase in continuous glucose monitor sales. MarketWatch +1 Investors Business Daily +1 Nutrition, sales rose by 3.8% to $2.15 billion, bolstered by the Ensure and Glucerna brands. MarketWatch Diagnostics, sales declined by 7.2% to $2.05 billion, primarily due to reduced COVID-related demand and procurement changes in China. MarketWatch Established Pharmaceuticals, sales increased by 2.8% to $1.26 billion, slightly above expectations. Smart Karma. The company's diversified portfolio allowed it to offset challenges in certain segments with growth in others. Strategic initiatives. Abbott is focusing on several strategic initiatives to drive future growth. Expansion in diabetes care. Abbott aims for its Freestyle Libre system to reach $10 billion in annual sales by 2028, capitalizing on the growing demand for continuous glucose monitoring. Investors Business Daily +1 Monexa AI +1 entry into weight loss market. The company has launched the Protality brand, offering nutritional products tailored for individuals using GLP-1 medications, addressing a growing market for weight management solutions. Monexa AI innovation in medical devices. Abbott introduced the Vault PFA system for atrial fibrillation, expanding its portfolio in the electrophysiology and structural heart markets. Investing.com. These initiatives demonstrate Abbott's commitment to innovation and its proactive approach to addressing emerging healthcare needs. Risks and challenges. Despite its strong performance, Abbott faces several risks. Tariff impacts. The company anticipates a cost of a few $100 million in the second half of 2025 due to new tariffs expected to take effect during Q3. Market watch. Regulatory challenges. Changes in healthcare regulations and reimbursement policies could impact Abbott's operations and profitability. Market competition. Intense competition in the medical device and diagnostics sectors may pressure margins and market share. Abbott's diversified portfolio and strategic initiatives position it well to mitigate these risks. Market outlook. Analysts maintain a positive outlook on Abbott's stock, citing its strong financial performance, strategic initiatives, and leadership in key healthcare segments. The company's focus on innovation and addressing emerging healthcare needs positions it well for sustained growth. In conclusion, Abbott Laboratories' robust financial results, strategic initiatives, and diversified portfolio underscore its potential for continued success in the dynamic healthcare landscape.